72 hours? That's how long it took. Just 3 days to transform the biggest precious metals rally we've ever seen into the most devastating liquidation event in trading history. Tuesday, Thursday, Saturday. 3 sessions, 3 critical moves. $10 trillion erased from existence. Before we go any deeper, I need you to grasp something crucial. What took place on Saturday wasn't just a crash. That term is too mild, too routine, too familiar. What we witnessed on Saturday was an execution. A surgical demolition of wealth so methodical, so carefully orchestrated, so flawlessly timed that once you see the complete picture, your entire view of financial markets will fundamentally change forever. Gold plummeted by 15%, silver collapsed by 40%. And this happened in just 6 hours, not 6 trading days, not 6 calendar weeks, 6 actual hours. That morning, no war broke out anywhere on the planet. No new pandemic surfaced. No major financial institution went under. No urgent headlines flashed across screens. No emergency announcements interrupted regular programming. Absolutely nothing. Total radio silence from every mainstream media outlet you can name. And yet, during that eerie quiet, $10 trillion simply disappeared into thin air, vanished as though it had never existed in the first place. But here's the part they conveniently left out of their explanations. On that exact same day, while your investment accounts were hemorrhaging value, while professional traders faced forced liquidations, while $10 trillion got wiped from digital displays worldwide, something equally dramatic was unfolding in our nation's capital. The United States federal government stood just hours away from a complete operational shutdown. Crisis stacked on top of crisis. Uncertainty multiplied by more uncertainty. And right there in the middle of this perfect storm, we saw the single largest one-day destruction of precious metals, wealth ever recorded in financial history. You really think that timing was just random chance? Stay with me here. I understand why you're watching this right now. Fear. Maybe you were holding gold positions. Maybe silver was part of your portfolio. Maybe you sat there helpless as years' worth of accumulated gains evaporated in one afternoon session, while the world offered you zero meaningful explanation for what was happening. The talking heads said it was just a healthy correction. They assured you that markets had simply gotten overheated and needed to cool down. They insisted this was completely normal and actually good for long-term stability. Let me give you the actual truth instead. This wasn't healthy price discovery. This wasn't natural market forces at work. This wasn't genuine buyers and sellers reaching a fair equilibrium point. This was a carefully written screenplay that had been drafted months ahead of time, practiced repeatedly, refined to perfection, and then executed with the kind of precision you'd expect from a classified military operation, all compressed into 72 decisive hours. And right now, today, I'm going to walk you through that screenplay line by line, move by strategic move, institution by institution. By the time this video ends, you'll know precisely who orchestrated this event, exactly how they pulled it off, precisely why they chose to do it this way, and exactly why they've executed virtually identical operations twice before over the past 50 years. Keep watching, because what I'm about to reveal will permanently alter your understanding of how these markets actually function. Let me transport you back to Tuesday, January 27th, 2026. That's exactly 3 days before everything came crashing down. President Trump is delivering remarks. Most Americans aren't really paying close attention at this point. It appears to be just another routine policy address, background noise for the evening news broadcasts, but then he makes a specific statement, one single sentence that almost the entire country completely missed. He explicitly says that a weaker United States dollar would create significant benefits for American businesses and manufacturers. He points out that America should adopt the same approach that China and Japan have been using successfully for decades now. Deliberately devalue your currency, artificially boost your export competitiveness, make your domestically produced goods cheaper and more attractive for international buyers to purchase. Now, to a regular person watching this from their living room, this sounds like abstract economic policy. Dry stuff, theoretical concepts, nothing that should trigger immediate concern or action. But inside trading operations across New York, London, Hong Kong, Singapore, and Zurich, phones immediately started lighting up, because professional traders understood with crystal clarity exactly what Trump had just signaled to the markets. The President of the United States had just publicly announced his preference for a weaker dollar policy going forward. And here's what every experienced trader knows cold. When the dollar weakens in value, gold prices rise, silver prices rise, all precious metals denominated in dollars rise proportionally. This happens because these metals are priced globally in US dollar terms. A weaker dollar means you need more dollar units to purchase that same single ounce of physical metal. Within just a few hours, the trade was actively on across global markets. Hedge fund managers began establishing short positions against the dollar. Institutional asset managers started aggressively loading their portfolios with gold exposure. Retail trading accounts started piling into silver contracts and exchange-traded funds. Billions upon billions of dollars flowing in one unified direction. Every participant betting on the exact same outcome playing out. Weak dollar coming, strong metals prices ahead. Tuesday was the precise day they set this trap perfectly, and absolutely nobody realized they were walking straight into it. Now let me take you forward to Thursday, January 29th. Gold reaches $5,600 per troy ounce. That's the highest nominal price in all of recorded human civilization. Silver simultaneously breaks through $121, another all-time high never before seen. These numbers were beyond anything most analysts had predicted even in their most bullish scenarios. Silver specifically had gained 68% during January alone. That represents the strongest single-month performance since way back in December 1979. We're talking nearly 50 years in the past. Social media platforms were absolutely exploding with activity. Every financial influencer with any following whatsoever was extremely bullish on precious metals. Market analysts were publishing price targets of $200 for silver. Some were calling for $300. A few bold voices even suggested $500 was mathematically inevitable, given the supply and demand fundamentals. On Monday of that same week, the iShares Silver Trust, that's the major silver ETF, recorded $171 million in net inflows from retail investor accounts. $171 million in a single 24-hour period. That marked the largest single-day capital inflow in the entire operational history of that fund. It was literally double the previous record that had been set during the famous Reddit-driven Silver Squeeze event back in early 2021. The total global silver market capitalization had expanded to approximately $6 trillion at the peak. Let me give you some perspective on just how massive that number actually is. That market cap was larger than Nvidia's total valuation, larger than Apple's market cap, larger than Alphabet, Google's parent company. One market strategist looked at the speculative frenzy and publicly labeled silver as the meme commodity of 2026. Euphoria was everywhere you looked. Everyone participating felt like they were winning big. Individual portfolios were showing gains of 50%, 100%, even 200% in some cases. Thursday evening, people went to sleep genuinely dreaming about early retirement possibilities and dramatic lifestyle changes. And not a single one of them knew that while they slept peacefully, the execution order had already been signed and approved. Saturday morning, January 31st, 6 o'clock Eastern Standard Time. Most people across America are still sleeping in their beds. The financial markets haven't opened for weekend trading yet. Coffee makers are just starting to brew. Some early risers are beginning their day. And then a headline drops. President Trump officially announces his selection for the next Federal Reserve Chairman position. The name is Kevin Warsh. Now, if you're just a regular person living your life, that specific name probably means absolutely nothing to you. Just another suit in a position of power, another bureaucrat in the Washington establishment, another forgettable face that'll appear on CNBC occasionally. But if you're a professional trader who truly understands how the Federal Reserve exerts control over the entire global financial system, that particular name just sent ice-cold fear shooting through your nervous system. Because Kevin Warsh isn't just any random economist who happened to get picked. Kevin Warsh is what market insiders call a hard money hawk. A policymaker who has dedicated his entire professional career to fighting against easy money policies, against artificially low interest rates, against deliberate currency devaluation and weakness. He represents the exact polar opposite philosophy of what Trump had signaled just days earlier on Tuesday. Do you see the deliberate contradiction being set up here? Tuesday morning, Trump clearly signals he wants a weaker dollar policy. Traders immediately respond by shorting dollar positions and buying precious metals. Saturday morning, just 4 days later, Trump appoints a Federal Reserve chairman who has built his entire reputation on supporting a strong dollar policy. The exact same traders who established short dollar positions on Tuesday were now being forced to rapidly buy back those positions on Saturday to close them out. The exact same traders who bought metals contracts on Tuesday were now being forced to sell those same positions on Saturday. Forced reversal of positions, forced selling pressure, forced liquidation events across the board. Tuesday and Saturday. Same president making both announcements. Completely opposite policy signals. 72 hours separating them. That's not policy confusion. That's not a communication mistake. That's a precisely engineered trap that snapped shut in 72 hours. But wait, because it gets significantly worse. Because even with just the Warsh announcement creating selling pressure, silver should have declined maybe 15% maximum, perhaps 20%, in a really bad scenario. A painful correction, absolutely, but something survivable for most position traders. What actually occurred was 40% total destruction compressed into a single trading session. How does that level of carnage happen? Because there was a third major player actively participating in this orchestrated event. A player that virtually nobody saw coming or expected to act. China. Let me explain something fundamental about how precious metals markets actually function in practice. When prices start falling sharply, there's usually a natural buyer waiting somewhere in the wings, someone who recognizes value at lower levels, someone who steps into the market and says clearly, at this discounted price point, I'm actively buying. For precious metals specifically, that buyer stepping in has historically always been China. They represent the largest consumer of industrial silver in the entire world. They consume enormous quantities for solar panel manufacturing, consumer electronics production, electric vehicle components. They have what appears to be an absolutely insatiable appetite for acquiring physical metal. Typically, when silver crashes hard, China immediately steps in. They aggressively buy the dip. They provide critical liquidity to stressed markets. They effectively put a price floor under the metal. But Saturday was completely different from historical patterns. At the precise moment when global markets desperately needed a buyer to appear, at the exact moment when sellers were completely overwhelming the system, at the critical moment when market liquidity was rapidly disappearing, China made a calculated decision. They deliberately stopped buying entirely. The Shanghai Futures Exchange, suddenly and without warning, raised margin requirements substantially. Chinese institutions stepped back completely and simply watched the carnage unfold without intervention. Now think carefully about this specific situation for a moment. American and European traders urgently want to sell their gold and silver positions because the Warsh appointment signals tighter monetary policy and a stronger dollar ahead. But the buyer, who has always, without exception, caught falling precious metals, meaning China, just walked away from the market entirely. Sellers everywhere across every exchange, buyers nowhere to be found. What happens in any market when everyone simultaneously wants to sell and absolutely no one wants to buy? The price doesn't just fall in an orderly manner, the price enters complete freefall collapse. And that's exactly what we witnessed happen in real time. And once this kind of cascade begins feeding on itself, nothing can stop the momentum. Silver dropped from 121 to 115 initially, then rapidly to 110. Then it shattered below the psychologically critical $100 level for the first time in weeks. That round number that every analyst insisted would hold forever as absolute support, gone completely in just minutes. $95, $90, $85, $80, $75, $46 per ounce erased in just 6 hours of trading. The ProShares Ultra Silver ETF, ticker symbol AGQ, that's the double leveraged silver fund, crashed 60% in a single session. 60% destruction. If you had $10,000 invested in that specific fund on Thursday evening, you woke up Saturday afternoon with just $4,000 remaining. Gold fell from $5,600 down to $4,700. $900 vanished per single ounce. That's $3.4 trillion of total gold market value completely wiped out in one trading session. The biggest single-day percentage drop since 1980. That's 45 years ago. One trading desk I contacted called it a complete capitulation event. Another described it as the largest single-day wealth destruction in precious metals market history. $10 trillion, one session, gone into nothing. Now here's where this entire situation gets genuinely fascinating from an analytical perspective. After the crash finished, I went deep into the actual data. Not the news headlines, not the expert analysis and commentary, the actual raw trading data directly from the exchange systems. And what I discovered in that data changes everything about how we should interpret this event. On Saturday, 531 tons of silver futures contracts were traded on the Shanghai Exchange. 531 tons. That sounds like an absolutely massive number on the surface. That sounds like genuine panic selling. That sounds like market participants desperately dumping their physical silver holdings. But here's what the actual vault data shows us. Physical silver, withdrawn from Shanghai Futures Exchange, registered vaults on Saturday. 0 tons. Let me repeat that critical fact again for absolute clarity. 531 tons of silver contracts changed hands electronically. 0 tons of actual physical silver metal moved anywhere. Not a single gram of real silver left the registered vault system. So what actually happened in reality? Paper contracts, pure paper shuffling. Short sellers needed an emergency exit from underwater positions. They got exactly that. They aggressively pressured the paper price downward with massive contract selling. They closed out their short positions at much lower prices, locking in profits. And buyers absorbed everything at the bottom prices. This wasn't a genuine market crash driven by real supply and demand. This was a position transfer between sophisticated players, shorts exiting cleanly, new longs entering at discounts, paper contracts changing electronic ownership, while physical silver bars sat completely untouched in secure vaults. The computer screens showed absolute chaos and panic. The actual vault inventories showed absolutely nothing happening. Now let me show you a number that should make your head spin completely. On Saturday, when COMEX markets closed in New York, the paper futures price of silver was $84 per ounce. On that exact same Saturday, when Shanghai markets closed, the spot price for physical silver was $122 per ounce. Same metal. Same calendar day. 44% difference. Let me make absolutely certain you understand what I just stated. If you attempted to buy silver through a futures contract on a screen in New York, the price was $84. If you attempted to buy actual physical silver metal in Shanghai from a dealer, the price was $122. If you went to Tokyo, physical silver was selling for $150 per ounce, a 44% gap between paper price and physical price on the same day for the identical metal. Which price represents reality? The paper price that can be manipulated downward with contracts backed by nothing tangible? Or the physical price where actual metal changes hands between real buyers and sellers? Here's what they absolutely don't want you thinking about carefully. In the weeks immediately before this crash, physical silver was selling for between $120 and $150 at bullion dealers around the world. And it was sold out. Dealers had virtually no inventory available. Customer demand was completely overwhelming available supply. Now ask yourself one simple logical question. If you're a precious metals dealer and customers are literally lining up willing to pay $150 for physical silver, and your inventory is sold out because demand is so incredibly high, why would you suddenly lower your asking price just because some electronic screen in New York shows $84? You wouldn't do that. It makes no business sense. The screen shows one number. Reality shows a completely different number. And the gap between them is 44% and actually growing wider. But here's what really convinced me personally that this entire event was scripted in advance. Remember exactly when this crash occurred? Saturday, January 31st, the final trading day of January, month-end settlement. Now let me take you back exactly 1 month prior. December 31st, the last trading day of December, month-end settlement. What happened on that specific day? Silver dropped 15% in a single session. Same pattern, same timing, month-end. And then what happened immediately after? Silver continued its powerful rally throughout January, went to all-time record highs. Now January 31st arrives, the last trading day of January, month-end settlement again. Silver drops 40% in one day. 2 consecutive month-end dates, 2 massive price drops. Identical pattern. Coincidence? Let me show you what else was happening on those exact dates. On December 31st, the Federal Reserve's standing repo facility distributed a record amount of dollars to major banks. Record amount, the highest ever recorded. And what was happening in Washington on January 31st while silver was crashing? The government was literally on the edge of shutdown, Congress scrambling desperately. Chaos everywhere. Now here's the connection that nobody in mainstream media is discussing. The banks that received those record repo dollars on December 31st, they're the exact same institutions that hold massive short positions in silver futures. The data is completely public. You can verify it on Fred Economic Database. You can see it on CME reports. Anyone can check this. Month end is when banks need to clean up their balance sheets for reporting. Month end is when they need to close risky positions. Month end is when they need liquidity injections. And month end, twice in a row now, is exactly when silver mysteriously crashes hard. December 31st, repo record, silver crashes 15%, then recovers. January 31st, government chaos, silver crashes 40%. The same pattern, the same timing, the same institutional players. This is not coincidence. This is a calendar, a script that executes on schedule. Now let me show you what the CME, that's the Chicago Mercantile Exchange, was doing behind the scenes while all this was developing. December 12th, that's 6 weeks before the crash, silver is rallying powerfully, making mainstream headlines. Regular retail people are making serious money. And quietly, without any public announcement or explanation, the CME raises margin requirements by 10%. Nobody really notices this change. That was precisely the point. December 29th, silver keeps climbing higher. CME raises margins again. 25% jump overnight. No advance warning to traders. December 30th, less than 24 hours later. They raise margins yet again, 2 separate hikes in 2 consecutive days. January 28th, that's 3 days before the crash. CME changes the entire margin calculation system. Fixed dollar amounts become percentage-based. 9% becomes 11%. 4 margin hikes over 6 weeks. 80% total increase in cash required to hold the same position size. Now, let me explain what that means for a normal retail trader trying to participate. You bought silver futures at $60. You've been riding this incredible rally for months now. Your account is showing big unrealized gains. Life feels really good. And then, without any warning, your broker sends you an urgent message. Your margin requirements have been increased substantially. You need 80% more cash deposited in your account immediately. Today. right now, or you face forced liquidation of your positions. Where does that cash come from on short notice? Most people don't have 80% extra cash just sitting idle, so they get liquidated, forced to sell whether they want to or not. And when thousands of leveraged traders are forced to sell at the exact same time, the price doesn't decline gradually. The price enters complete collapse mode. But here's what should genuinely disturb you about this sequence. After Saturday, after the crash finished, after 10 trillion vanished, the CME raised margins again, Sunday morning. The day after the massacre, another hike, gold margins going from 6% to 8%. They raised margins before the crash to cause forced selling pressure. Then they raised margins after the crash to prevent any recovery. If this was truly about risk management, as they claim, they would lower margins after volatility subsides. Let the market heal naturally. Let traders recover. Instead, they increased the pressure further. They kept their boot firmly on the neck. That's not protection. That's deliberate suppression. Now let me show you why this matters far beyond just Saturday's events. This is not the first time they've run this exact script. 1980, silver runs from $6 to $50, 800% gain, regular people making fortunes. The Hunt brothers attempting to corner the physical market. What happened? CME created Silver Rule 7, banned all leveraged buying overnight. The Federal Reserve raised interest rates from 11% to 20% in a single dramatic move. Result, silver crashed from $50 to $10, 80% destruction. 2011, silver runs from $8 to $50, 600% gain. Retail traders everywhere participating, banks with massive short positions getting absolutely crushed. What happened? CME raised margin requirements 5 times in just 9 days, 84% increase. Result, silver crashed from $50 to $26, 50% destruction. It took 13 years to recover to those levels. Now 2026, silver runs from $26 to $121, nearly 400% gain, the biggest rally in modern history. What happened? CME raises margins 4 times in 6 weeks. China raises margins and steps back from buying. Fed chairman announcement timed to cause maximum reversal. Government on edge of shutdown, shorts get their exit through paper manipulation while physical sits untouched. Result, silver crashes 40% in a single day. The fastest destruction of all 3 events. 1980, 2011, 2026. Same pattern, same tools, same timing, same destruction, 3 times in 50 years. Every single time, silver threatens to break free from control. Every time, regular people start making real wealth in precious metals. Every time gold and silver start exposing the fundamental weakness of paper money, the same script executes. Once is an accident, twice is a coincidence, 3 times is deliberate policy. But here's what should make you absolutely furious when you think about it. While paper prices were crashing, while retail traders were getting liquidated, while 10 trillion was being erased from screens around the world, guess what central banks were doing? Buying, not selling. Buying physical metal. 800 tons of gold accumulated by central banks last year, the fastest accumulation pace in decades. The dollar's share of global reserves has dropped to 58%, lowest since 1995. For the first time in modern history, gold now represents a larger share of central bank reserves than U.S. Treasury bonds. Let that sink in completely. Central banks around the world now trust a yellow metal more than they trust America's promise to pay. They crash the paper price. Then they buy physical at the discount they just created. Retail sells in panic. Central banks accumulate in silence. It's the greatest wealth transfer in modern history. And it happens every single time they run this script. And that brings me to the most important part of this entire video. I want to talk directly to you right now. I know you're scared at this moment. I know you watched your portfolio bleed. I know you're wondering if you should just sell what's left and walk away from precious metals entirely. Let me tell you what I told people just days ago when silver was at 121 and everyone was euphoric. When everyone is greedy, be a little fearful. And now when the market is drowning in fear and panic, logic says the opposite. When everyone is fearful, be a little greedy. That's not financial advice. That's not me telling you specifically to buy or sell. That's just how markets have functioned for centuries. Fear and greed, cycles that repeat endlessly. The people who panic sell at the bottom always regret it. The people who buy when there's blood in the streets remember it as their best decision. Which one will you be? Here's the question I cannot stop asking myself. If gold and silver truly don't matter, if they're just relics of a past economy, if they have no place in the modern financial system, then why do they keep doing this? Why coordinate a Fed chairman announcement with a crash? Why have China stepped back at the exact moment liquidity was needed? Why raise margins 4 times before and once after? Why does the paper price show 84 while physical sells for 150? Why run the same script on the last trading day of December and the last trading day of January? Why does the standing repo hand out record dollars to the same banks that are short silver? Why spend so much coordinated effort suppressing something that supposedly doesn't matter? They say it's market forces. They say it's supply and demand. They say it's normal volatility. But 10 trillion don't vanish in 6 hours by accident. 531 tons of paper don't trade, while 0 physical moves by coincidence. 44% gaps between paper and physical don't appear in healthy markets. You don't fight this hard against something that doesn't matter. The intensity of the attack tells you the value of the target. They're not protecting the market. They're protecting the dollar, protecting the system, protecting the narrative that paper money works. And the fact that they keep running this script, the fact that they've done it 3 times in 50 years, the fact that they will do it again, tells you exactly what precious metals represent. A threat, a way out, real money that exists outside their control. That's why they attack it. That's why they crush it. That's why they will never stop trying to suppress it. Because if gold hits 10,000 and silver hits 300, what does that say about the dollar? What does that say about 50 years of money printing? What does that say about the entire system they've built? It says the paper has failed. It says the game is ending. It says everything they told you was a lie. That message cannot be allowed to spread. So they write scripts like this one: Tuesday, Thursday, Saturday, 72 hours of controlled demolition. And they expect you to panic. They expect you to sell. They expect you to give up and walk away. But now you know the script. You've seen the 72-hour timeline. You've seen Trump's contradicting signals. You've seen China's perfectly timed exit. You've seen the 531 tons of paper with 0 physical movement. You've seen the 44% gap between screen price and real price. You've seen the month-end pattern. You've seen the standing repo connection. You've seen the margin hikes before and after. You've seen the same playbook executed across 50 years. It was scripted. Every single piece. They called it a crash. I call it the 3rd time in 50 years they told you exactly what they fear. They called it volatility. I call it a 72-hour execution. They called it risk management. I call it the system showing you its hand. And what they fear is simple. You holding real metal outside their system, beyond their control. Remember that 44% gap I showed you earlier? Paper at 84, physical at 150. That gap is not a glitch. That's the system telling you which price is real. Paper is just a promise, a number on a screen. Metal is real. It sits in vaults. It cannot be printed. It cannot be hacked. It cannot be margin called out of your safe. They can crash the paper price. They cannot crash the metal itself. They can liquidate your futures contracts. They cannot liquidate the silver bar sitting in your possession. 3 times in 50 years they have run this script. 3 times silver eventually recovered and went higher than before. The question is not whether silver recovers. History says it will. The question is whether you will still be holding when it does. Real money in real hands, beyond their reach. Now you know the script. What you do with this information is entirely up to you. Subscribe if you want to keep seeing what they don't want you to see.